the equity shares, debentures, bonds, preference shares are the instruments that are traded in the capital market. These institutions may include either banks, credit unions, insurance companies, investment companies, and other financial service providers. Among the financial institution, there is also specialization. Specialization means there are institutions which are specialized in particular financial services. Hello everyone, I am Niklavati S, Faculty of Commerce, Vidhyaashram First Grade College, the Temple of Excellence, MYSURU. I welcome you all for the sessions on the subject Financial Markets and Services. So, we are discussing about the second chapter, that is Financial Institutions. So, we all know that financial institutions are the important component of the financial system in India. So, these are the institutions or the organizations which provide financial services to the individuals and businesses. So, the financial institutions play a vital role in contributing or bringing the financial stability or towards the economic growth, as well as to invest and channelize the money of or the savings of the common people towards the productive investment. Let us understand more about what are financial institutions and what is their characteristics. So here, the financial institutions are nothing but the organizations that provide the financial services. It might be any services, maybe for example lending loans or giving insurance coverage or giving some financial related advice that ease the financial transactions of individuals and businesses. So here it is those organizations which provide financial services to the individuals, business and other entities, and these institutions may include either banks, credit unions, insurance companies, investment companies and other financial service providers. So, these financial institutions consist of various banking and non-banking organizations that may include the commercial banks or the developmental banks or insurance companies or investment companies. So, to understand more about how these financial institutions are functioning, we need to understand what is their characteristics or the features or how or what role they play, the financial institutions. So, here as we look into the characteristics of financial institution, it plays the intermediary role. That means the financial institutions like banking or non-banking institutions or any commercial banks or any developmental banks, they play an intermediary role between the borrowers and the lenders, between the savers of the money and those who need the money. So, they play an intermediary role. So, they are the intermediaries as they collect the savings of the people towards, and they channelize that money towards the investment or they give for those who need money or to the borrowers. So, say for example, in a bank may accept deposit from person A and it may utilize those deposits to lend loan to some other person called B or C. So, in that way. Next is they are regulated by authorities. So, all the financial institutions are regulated, they have to follow certain rules and regulations, and they are regulated by certain acts, as well as they are responsible to report to the affects financial institutions. Say for example, for the commercial banks, they have to report to RBI and they have to follow all the rules and restrictions that are put by the RBI. Next is the provision of financial services. So, why do the financial institutions exist? It is to provide the financial services. Why the financial services are needed? In order to ease the financial transactions of the individuals and the businesses and other entities, and also to make use of the money or the fund that is available in a more productive way, which contributes towards the development of the economy, the development of the infrastructure, etc. And among the financial institution, there is also specialization. Specialization means there are institutions which are specialized in particular financial services. Say for example, there are only stockbrokers. So stockbrokers companies which provide the facility of this trading, or there are only commercial banks that are dealing with accepting deposits and lending money. And there are developmental banks, say for example NABARD, which concentrates to the development of agricultural sector. Or there is IDBI, Industrial Development Bank of India, which contributes, and it was introduced or established for the purpose of development of industrial sector in India. So there is specialization in terms of services, either commercial services, developmental activities, or lending loans. There are investment companies, or there are insurance companies only for the sake of risk coverage, etc. Next is there is facilitation of payment system. So facilitation of payment system. So because of the financial institutions, we are able to use many apps like PhonePe or Google Pay and make the payments to whomever we want, like whether it is through just transfer to a friend, or just paying the bills, or paying when we shop something, or transferring the money through NEFT or RTGS. That is all is possible because of the financial institutions. Next is mobilization of savings. So one of the main objective of the financial institution is to mobilize the savings. So mobilize the unused funds, or the extra or the surplus amount that is there with the people towards the productive investments. Moving forward, let us study some of the other characteristics. Then there is risk management. That means these financial institutions exist for managing the risk and giving the risk coverage for the individuals and the business. Say for example, our by providing health insurance, so they cover the risk of the amount that is incurred at the time of any kind of health issues, or they help us to pay our hospital bills, like that. And life insurance policies, they help us to cover the risk of the family after the demise of a person in that way. And there is a liquidity creation. That means these financial institutions not only mobilize the funds, but also they provide lot of liquidity, like the depositors or the individuals, they can draw the amount at whenever they need. So there is liquidity, and also they can get short-term loans from the financial institutions like bank and other organizations. Next is economic growth driver. So the financial institutions as part of the financial system is very important in order to contribute towards the economic growth, as they invest the money collected as from the depositors. Through the lending of loans, they give the loans to the entrepreneurs or the industries, or for the development of the infrastructure of the country, which contributes towards the economic growth. Then there is profit oriented operations. So of course they also perform the operations with the aim of getting profit. So they also generate profit and revenue through the interest rates, and also they invest in those companies or those areas or those sectors where they can generate more and more revenue, both for the government as well as for maintaining the wealth of the individuals and the businesses. Next is global integration. So due to the financial institutions at the global level, just like central banks and Citibank, HSBC banks, so all these play a major role for integrating the activities, financial activities at the global level, especially for the international businesses like global companies or MNCs, etc. Next is technology dependence. So They are all, technology dependence, because they make use of the advanced technology, so that there will be a financial inclusion of, and there should be the awareness and the usage of these financial facilities or the services by the people. That is possible only when they are be you know they'll be able to access to these services, and these services are made accessible because of the technology we have, because of the digitization, and the people are moving towards. Next is customer focus. So of course, whatever the financial services that the financial institutions are providing, whether, say for example, if you take the example of commercial banks like SBI or HDFC, so all these services that are provided by the banks, even the post office for that matter, they are into the field of this financial inclusion, and they are providing saving schemes, RD, FD, loans, etc. The post office, for that matter, they are into the financial inclusion, and they are also providing and encouraging the saving system among the people, especially in the rural areas. They are encouraging for RD, FDs or MIS schemes like that. So let us move on to the next topic, that is, what are the broad categories we have in terms of money market institution and capital market institutions. So here, when we talk about the financial institutions, so based on that also, in a broader way, these financial institutions can be divided into money market and capital market institutions. So in the money market institutions operate in short-term financial market. So whenever we say money market, it refers to the short-term financial market, where all the securities that are traded will be for, will have the maturity less than 1 year. So either it will be for within 1 year, and they provide instruments and other facilities for borrowing as well as lending funds with maturities typically less than 1 year. Next, some of the features of money market institutions include, like they usually deal with, even if you take the example of commercial banks also, they deal with the short-term funds as part of the money market institution. Then they focus on more and more liquidity and safety of investment, as like whenever the people want back their money, the depositors want their money back, they can easily encash it, and there is a safety of investment also. Here the risk will be low compared to other capital market instruments. Then instruments usually have low returns but are highly liquid. So usually they have low returns as well as low risk, but that they can be withdrawn whenever the people or the investors want. Next, some of the money market instruments can be, the issuance of treasury bills, commercial papers, certificates of deposit, call and notice money. So in treasury bills, when we talk about, these are issued by the government to raise short-term funds, and commercial papers are unsecured promissory notes that are issued by the corporations. Next, certificates of deposits or the short-term deposits, that are these are the certificates issued by the banks to the investors or the depositors on the amount of money that is deposited with the bank. Next, call and notice money is like interbank short-term loans that is lent. Now let us move on to the next topic, that is capital market instruments. So the only difference between the money market and the capital market instruments here is about the maturity of these financial instruments. So here the maturity of the financial instruments is like more than 1 year, and the equity shares, debentures, bonds, preference shares are the instruments that are traded in the capital market. So at the broader way, so there are equity shares. They represent the ownership right of the shareholders in the business, and they are issued for the longer term. And here the shareholders also expect the long-term returns, and debentures and the bonds are debt funds, that are the certificates that are issued to the creditors whoever the financial institutions or the individuals, those who have lent money to the corporations. Then there are preference shares, which are the mixture of, they are also called as hybrid shares, where it has the mixture of equity shares and debentures bonds features, where these shares will receive the shareholding, as well as they'll be receiving the dividends for the shares, and they have the quality of the debenture because they have that preference, and also to get the regular dividend, just like interest that is provided to the loan. So they are able to or liable to get the dividend on a frequent or regular intervals. Next, they're also having the shareholding in the company. Now, let us look into the comparison between the money market institutions and the capital market institutions. So, in terms of time horizon, in money market institutions, they deal with the short term funds which are have the maturity within or less than 1 year, whereas in capital market institution they have the maturity of more than 1 year and they are called as long term. So in primary instruments that are dealt or that are traded in the money market institutions include treasury bills, commercial papers and certificate of deposits and call money, whereas in capital market it includes equity, bonds, debentures, mutual funds. Next, when we compare the purpose of money market institutions and the capital market institutions, here in money market institutions they deal with more and more liquid funds, as well as the safety of the funds is seen, whereas in the capital market institution the capital formation and it's for the investment of that particular money for the longer period of time. Then coming to the participants in money market institutions, the participants are the central banks, commercial banks and other mutual funds agencies, whereas in capital market institution it includes stock exchanges, investment banks and insurance companies. Next, the risk and return aspects. Here in money market institution they deal with the low risk financial securities, as well as they'll have low returns. Then in capital market they deal with the securities having higher risk and higher returns. So this was the summary about the money market institution and the capital market institution, and we have discussed what is the financial institution is and what are its characteristics in this session. Hope you all have understood. Thank you.